And I always think there's like a small band of bullish people on the builder, Stephen. It's you, it's Bill Smead. I mean, I keep talking about these low valuations. What do you say can power the next leg of a rally here?
I think the real issue, Kelly, is whether or not this buyer slowdown that we've seen as a result primarily of unaffordability or some mental issues, such as like just negative psychology, concern, fears, and maybe a little strategy from people who think they're going to get a real buying opportunity if home prices go down. We're hearing that it's a lot more mental than it is math. In other words, we're hearing that it's not so much that people can't afford as much as they're sitting on the sidelines, and we don't think that these folks have very much in the way of alternatives. Rents are going through the roof. There's just not a lot of standing inventory on the market in a finished form. And as a result, we're pretty confident you're going to see buyer demand come back fairly strongly by the end of the summer. And we think that's probably going to be the catalyst for this group, which, as you point out, is just historically cheap.
I look at the market, Stephen, and you see what I see: bond yields rolling over, and all this talk about the consumer. I mean, it just seems like that would be out of keeping with where momentum is heading, would it not?
Well, I think you're right. Bond yields are rolling. We're also seeing MBS yields roll. We think spreads right now are really, really high. The mortgage rate is much higher relative to the 10-year yield than it usually is. These are all reasons why we believe the mortgage rate is very likely to remain range-bound, or frankly, even lower by the time you get to the end of the year. That would be a help. Now, certainly, I don't want to misrepresent what we're seeing in the market. The market right now has definitely cooled. Many would argue that it kind of needed to. It was getting a little bit too frothy, if anything, that we were a little worried about that earlier in the year. So we do think the Fed's going to see signs of housing slowdown. We think in particular we're going to see housing starts slow. We're hearing that the builders are reacting to this environment by slowing their roll a little bit on production. Actually, that's going to help sustain pricing, because if you don't add a lot of supply, you actually help sustain pricing. So folks who think you're going to see a big drop in prices, I think that's where the disconnect is. And that's why I think this group is mispriced.
That's where I was going to go, Stephen. You anticipated my question. If you have more tentative buyers, that suggests a softening of demand that would therefore in turn suggest maybe a softening of prices. But if you're squeezing supply or slowing down new houses coming on, then you're compensating for that. Are you seeing the possibility of price cuts, or are you seeing any builders having to throw in incentives, a little less premium price on some extras or whatever?
Yeah, so that's the good news and the good news. So on the one hand, yes, you are starting to see concessions. You needed to see that. I mean, I think for the housing market to just not see anything would defy belief, and it also wouldn't make the Fed too happy. So we are seeing concessions increasing. We are seeing incentives rising. However, we're seeing those incentive levels still below normal. That's what we heard from Pulte. We heard it from D.R. Horton last week. These are some of the largest builders in the country. So yes, we're seeing some deals starting to materialize, but they're actually less in the way of discounting than we have historically seen as normal. And so it bodes very, very well for the outlook for the fundamentals for these stocks.